we're going to use our formula in all the different colors to color code this question and kind of move on this question step by step together. So as we proceed, I'm going to highlight things and be like, oh, a bell should be ringing for you here. If you read this question, this is what we're going to use for the equity section, or this is what we're going to use for the debt section, and so on. So let's go ahead and do this together. So Shy Designs has been publicly listed on the Toronto Stock Exchange for a few years. The firm's common stock has 0.95 million shares outstanding with a book value of $35 per share that regularly pays a dividend to its shareholders. So let's take a step back for this specific sentence. We got a few interesting things here, all right? So let's go ahead and take out our red highlighter. Let's highlight that there are 0.95 million shares outstanding, okay? That's very important for us. However, what I want you to also be able to identify is that, well, the book value per share, that doesn't do anything for us. The reason why it doesn't do anything for us is because we want to take the price per share that's like currently trading, not the book value. Because the book value, essentially what it is, it's the initial, all right, it's the initial issuance price for those common shares when there was an IPO back in the days. Well, maybe the stock is trading at a higher price. Maybe the stock is trading at a lower price, okay? That's why it's important to actually use our equity valuation formulas to solve for the present value of these stocks, of these common shares. And also, if you're on an exam, and you'll see in the next sentence, if they give you a bunch of information, right, that's related to a specific chapter and that's related to a specific formula, you want to have the presence of mind to understand that, you know what, maybe I want to plug these things in, right, because it's helpful. That's exactly what we did back in the day. So hopefully that's clear. So for us, whoa, this is a little bit too big. That's, anyways, I'm not gonna, this is a kid's show. You gotta stop saying nonsense. So we're not gonna take this into consideration. All right, let's move on to the next sentence. Note that Shy Designs just paid a 1.6 annual dividend, okay? And the CEO mentioned that it is expected to grow at a rate of 3.5% per year indefinitely. Now there's a lot of good stuff in this sentence, and let's go ahead and highlight them together. So number one, they told you that they just paid a dividend for $1.6 per share. That's extremely relevant because this is what we're going to call D0, all right? Extremely relevant. And then we're going to try to find these things in our formulas there. Then they also told you that, well, the dividend is expected to grow at 3.5% per year, okay? Forever, indefinitely. So in other words, you could set your G as being 3.5%. So let's go ahead and write that, 3.5%. Oh, man. All right. So now that we have that, we can move on to more of this problem together. Notice how we're just making sense of things, okay? We're just working through this together. And let's even erase more of the fluff. Like, we just care about the stuff that we highlight. The rest doesn't matter to us. Now, if we move on to the next sentence, they're telling you that, hey, the common stock, okay, their common stock has a beta of 1.65, while the standard deviation on the market portfolio trends towards 10.45%, while its annualized returns yields 10.5%. So let's walk through the noise here. Let's highlight what's relevant. They just told you that the beta, all right, of the common stock is equal to 1.65. And that's extremely important. Why is it extremely important? It's because if you look at your flowchart, you know that if we want to solve for the cost of equity, we need our beta. And in this case, they gave you the beta. All right, so we could go ahead and say, you know what, beta is important. Beta is equal to 1.65. I really want to have that in mind. Then they're letting you know that the standard deviation of the market portfolio trends towards 10.45%. Now, if this is the first time you're doing a question like this, you need to go back to your formula, okay, for your cost of equity, and you say, I don't care about this because within my cost of equity formula, I don't see sigma. I don't see the standard deviation anywhere. So we don't got to use that, all right? So let's not use that right there. We could just put that as being no bueno for us. You go ahead and remove this. It's just noise that we don't need. However, they also let you know that the annualized returns on the market portfolio is 10.5%. That's important for us. The annualized returns of the market portfolio, all right, is 10.5%. And if we go back to our flow chart, hey, ERM's right there. We need that. Okay, so let's go ahead and highlight this as being equal to 10.5%. We're also letting you know in the next sentence that, well, maybe you want to note that the risk-free rate of return is 2.8%. That's okay. Let's go with that. That's very important to us because we know that that also stems within our CAPM formula. So far, so good. We're having a good time. 2.8%. All right. Now, if we read the next sentence, let's read it together. You'll see why I said Also, the firm has 0.5 million preferred shares outstanding with a face value of $100. Now we could go ahead and take another color because now we're talking about preferred shares. So let's go ahead and highlight the stuff that we need here in a different color. So we have 0.5 million preferred shares outstanding. And the reason why that's important, if we go back to our little flow chart, is because we know that if we want to solve, okay, we're right here. If we want to solve for the market value of preferred shares, well, we need the number of preferred shares outstanding. In this question, they gave you exactly that number. And they also gave you what the par value / face value is. It's $100 here. Amazing stuff, amazing stuff. So you can go ahead and highlight that as well. So we got, I'm not going to highlight that part because it's not like a symbol or anything, but our face value, so we're going to call this our par value. All right. Now, surprisingly, if we read the next sentence, preferred shares are trading at 92%, while the preferred rate trends towards 5%. That's very interesting. We know that the premium here, or the discount on preferred shares, well, it's at 92%. So here we could write discount, and we're going to use that to find the present value, so the price of those preferred shares. And they're also letting you know that the preferred rate is 5%. Now, what is the preferred rate? The preferred rate, essentially, call it R, is going to help us to solve for the dividend on preferred shares. And the dividend on preferred shares, which is what we have right here, it's equal to the face value or the par value, you could call them the same thing, times the preferred rate. Let's do some quick math. $100 times 5%, we get $5. That's going to be your dividend on preferred shares. Okay. So now let's read the next sentence. They're telling you, however, Shy Design's capital structure holds traditional long-term debt in the form of 10-year quarterly coupon bonds with a face value of $1,000, which were issued this year. A lot of stuff here in this sentence. But let's take our time and let's highlight this in orange, and let's try to make sense of what has been shared with us. Let's get it. Let's get it. Let's go into this. So in this case, we know that there's also some long-term debt, okay, in the form of a 10-year quarterly coupon bond. Quarterly coupon, I guess I should go get quarterly coupon bond with a face value of $1,000, and they were issued this year. So there's a lot of stuff, okay? Well, let's kind of make sense of this. The reason why this is important is because we know that we have 10-year quarterly coupon bonds that were issued this year. So they weren't issued 10 years ago or 5 years ago or 3 years ago, they were issued now. The reason why that's important is because when we calculate our N, we will know that, okay, our N is equal to the amount of years multiplied by the frequency. And the frequency stands for the number of payments within a year. And in this case, if somebody were to buy these bonds, they would have 10 years worth of bonds and 4 payments per year, such that if we take these two into consideration, we would say, well, N is equal to years times frequency. And that would be 10 times 4. And that's 40. And the reason why we're going to let our N remain at 40, it's because we understand that anybody who buys the bond right now, if we read the question, they're going to benefit from all of those 40 payments. So that's amazing news. Now we also get our face value at $1,000. So that's going to be F equals 1,000. And we also know that, once again, the bond was issued this year. So that's a bunch of really good information. Let's go ahead and read the next Okay, the next sentence. The firm issued 100,000 bonds with a coupon rate of 8%, while the annualized yield to market, so the annual yield to market, is 4%. Let's make sense of this sentence together. So the reason why 100,000 bonds is relevant to us is because we know if we go into our flow chart and we look at the market value of debt, we know that the number of bonds issued or outstanding is crucial. Okay. In this case, we need that because we want to solve for the market value of debt. They also told you that the coupon rate is equal to 8%. The reason why this is relevant is because with that, we're going to be able to solve for our coupon, all right, our coupon payment. And don't forget that your coupon payment is the coupon rate multiplied by the face value, all right, divided by the number of payments in a year. So your coupon in this case, all right, if you do some quick math, it'll be 1,000 times 80. That's going to give you $80. All right, divided by 4, it's going to give you a coupon of 20 bucks. I hope that's clear for everybody. It's going to give you a coupon of 20 bucks. And if we look at the annualized yield to market, so in other words, the YTM, and they're telling you it's 4%, well, that's important because we know that we can now get our KB, which is what we need for a valuation formula, right? Right here, KB. However, KB, it's not 4% here. KB will be equal to 4 divided by the frequency. There are 4 payments per year such that your KB will be 1%. And of course, our YTM is also very important for us to be able to solve for our cost of debt, which is what we're going to use here. So we're going to do 4% divided by 4 plus 1 to the power of 4 minus 1 to get our effective annual cost of debt. That's how I'd like to call it. So now that we have that, we can now move on to just the last sentence, which is simple. We don't even need to highlight this in a specific color. We can put this in yellow. We know that the corporate tax rate is equal to 28%. Amazing stuff. You need that for your formula on WACC. Then we're also going to highlight the mission of this question, which is, I mean, at this point, pretty obvious, but it's going to be to calculate the firm's WACC. All right. So now that we walk through the question and you literally have everything that you need to solve this, we're going to walk through the flow chart one by one. We're going to start with equity. We're going to solve for the market value of equity and the cost of equity. Then we're going to go into debt. We're going to solve for the market value of debt, and then we're going to solve for the cost of debt. And finally, we're going to go into preferred shares, and we're going to solve for the market value of preferred shares and the cost of preferred shares. Once we have all of this information, we'll be able to solve for the total value of the firm, right? Because we're going to add equity plus debt plus preferred shares, right? Their market value. That's going to give you the value of the firm. Once you have that, now magic happens because we'll be able to find the proportion of equity to value, the proportion of debt to value, and the proportion of preferred shares to value. And with that, we'll be able to plug in all of the information within our WACC formula and get our answer. It's really as beautiful as that. All right, so let's go ahead and move to the first step, all right, which is solving for all of the equity portion. So as you can see, I already have some inputs here, but we're going to work through it together. What I'd like to do is, I guess I'm going to put this in a different color. I feel like we're zoomed in enough. Yeah, I mean, that's okay. Okay, so what I would like to say in this question is that they gave us the risk-free rate. They gave us a bunch of good stuff. All right, now what I'm going to do is I'm going to pop up the question myself such that we're able to work through it together. So let me just do that. It won't be too long. I'm just going to grab the question. Just like that, I can make sure that it's like we were working on it together type thing. Cool. No, it's not as pretty, but we got what we need. So what's awesome here is we're going to start with finding our cost of equity, okay, our KE. It's going to be part 1 here. Now, what's awesome with our KE is that we literally already know what our risk-free rate is. We already know what our beta is, and we already know what our ERM and, of course, our risk-free rate is. So with that, we're going to be able to solve for KE, and we're going to do that together. Why not? So I could go ahead and kind of say, okay, we have our 2.8 for our risk-free rate. we have our beta of 1.65 on the common stock of Shy Designs. We have our ERM, which is 10.5. Okay, and by definition, we would have our risk premium. So we could go ahead and plug this in within our formula. We would know that KE is going to be equal to 2.8% plus 1.65 times 7.7%. Now, this is my first time ever doing the question. So I'm going to be super transparent and we're going to work with it together. Now, it's my first time solving it without my problem creator that I have there. So that's what I mean by it's a little bit different. But I want us to work on this together such that you really have the most comprehensive view that you could get. Okay. And in this case, when we plug this in within our formula, you would get that KE is going to be equal to 15.505%. Now you could round it up. It's really up to you. It's up to your discretion. So now that we have that, we could go ahead and identify that, yeah, okay, cool. We have our cost of equity. And you could even be as funny as myself. You go ahead and say, okay, boom, we have our cost of equity. And by definition, low-key, we also have our tax rate. So we're just solving for these pieces one by one. All right. So now, in order for us to find the market value of equity, we need to know, okay, well, which formula are we going to use? If we go back to our question, we remember they gave us information that Shy Designs just paid a dividend. And that means that that's D0. In the question, our just paid dividend was equal to, if I could go grab it real quick, it was equal to 1.6. So we could go ahead and identify this, right? Our D0 as being 1.6. So we have that information. However, now what's really awesome is that we also have our K, which is our cost of equity. So we have that as well. And in the question, so I can maybe even erase this here, which is 15.505 or 15.51, so we're up to you. And the question, they also gave us our growth rate. And the growth rate here is 3.5%. Okay, so that's what we need as well. And we have that. If you read the question, remember how we highlighted things together, and it's 3.5%. So now all that we need to do is plug that in within our formula. So we know that the present value of our common shares will be equal to 1.6 times 1.035 over K minus G. So it's going to be 15.505% minus 3.5%. And that's going to give us a price of, now of course I already have the questions, but I like working it with you guys such that it kind of creates this feeling that you're doing this with someone. I guess that's my thesis on the whole thing. Maybe I'm totally off, but it's whatever, I'm here to help, so that's what matters to me. So we're gonna have 15. Like this. We're going to have 1.6 times 1.035 over 0.1505 minus 0.035. And that's going to give you a very interesting amount. Just going to make sure that it's okay. Am I on? Open. I'm just making sure that my answer is correct, but I seem to have something that's not working too well here. I seem to have two different amounts. Now I'm not sure if I'm doing some sort of weird stuff. So let's go ahead and work through this together. So we're going to have, that's so strange. Oh, we'll do this myself. I'm good. So we're going to have on our numerator 1.656. We're going to have on our denominator On our numerator, we're going to have essentially 12, whoops, 0.12005. If you do that, I don't know what I did before. Maybe I'm on some sort of dark magic, but the answer is what I had from the very beginning. I guess I just wanted to proofread my stuff, but no, your price per share is going to be equal to 13.79425. Curious why it didn't work before though. So that's exactly what I got here as well. It was funny because I'll be totally transparent. I was doing the question before, but for some reason, I guess I made a mistake while I was retranscribing my stuff. Ah, I know what I did. My bad. I'm just dyslexic. Yeah, I'm dyslexic. It's okay. But anyways, it's always better to be extremely diligent than to be a fool. In this case, I'm both. So now that we have our price per share, we could actually go ahead and find the market value, okay? Because we know that we have, in terms of number of shares outstanding, we have 0.95 million. So we have 950K. So we know that the market value of equity, okay, so we could call it equity, is going to be equal to 0.95 million multiplied by 13.79425. That's going to give you that equity. Okay, so if we go ahead and kind of erase this stuff, it's going to give you that the total value of equity for the firm. This one is you just got to plug it in within your calculator. It's going to give you 13,104,539. Okay, and that's going to be the value of equity of the firm. Now, if you do some quick math, that should make some sense. It's a little bit smaller than if you just did this times a million. So for me, my sense check works. Now, on an exam, I would definitely recommend kind of keeping it as unrounded as possible. Try to keep your numbers whole. But for us, we're going to work with this. So now we have our equity value. We don't have equity over value of the firm, but we definitely do have our equity. So what I'm going to do, because I want us to at least have some sort of like short-term, dopamine, we're going to go ahead and do a little check mark on E. Okay. So now we're good. We can move on to our debt portion. And our debt portion, once again, what we're going to do is we're going to solve for our cost of debt. Then we're going to solve for our market value of debt. But in order for us to solve for our market value of debt, we're going to need to find the price per bond. All right. So let's begin with the first little beast that we have here, which is a little bit strange, because this doesn't seem like something that's, appealing, this little formula that we have. But there's actually a very easy rationale to have here. And I want you to remember this. Remember, under our time value of money chapter, we did the following to find an effective periodic rate, or an effective annual rate, really. What we did is we did this plus QR divided by M to the power of M minus 1. Well, in this case, if you're sharp, you can notice that this is the quoted rate. This is M, and this is M. And this is the effective annual rate. And that's exactly what we're trying to do here. We're trying to find the effective cost of debt. In this case, we know that the yield to maturity that was provided in the question was 4%. But the number of compounding periods, right? The way we're going to visualize this is the number of payments, okay? So the number of coupon payments. And in this exam question, we know that the number of coupon payments, well, it's equal to 4. Why is it equal to 4? Well, if you go back to the prompt, they let you know, hey, by the way, we get quarterly coupons. So we're making payments every essentially 3 months. So you could go ahead and say, well, we got these two values. Boom, just like that. That's amazing. So with that, we're going to be able to solve for our KD. It's going to be a walk in the park. So KD is going to be equal to 1.01, because we're taking 4 divided by 4, to the power of 4 minus 1. And that's going to give you, I could literally do it with y'all on my calculator. 1.01 power of 4 minus 1 times 100, because we want a percentage. We're going to get KD is equal to 4.06. That's so ugly. 0604. We just got our KD. It's literally as easy as that. All that we had to do is we had to use this formula to our advantage. Okay. So if you go ahead and go here, boom, we got the same answer. Look at that. Now we need to find the present value of our bond. And in order for us to do that, we got to go back in time and go look for our bond valuation formula. All right. And this is exactly that, our bond valuation formula. That's exactly what I highlighted here. Now, if we go back to our prompt, we've identified C, we've identified KB, we've identified all those good things. Let's go ahead and do it again. In the question, they told you that the face value of the bond is $1,000. So you know that the face value is equal to 1,000. That's super cool. We also know that the coupon, what is a coupon? Well, the coupon is going to be easy. It's going to be F times the coupon rate divided by the number of payments. In this case, we know that our face value is $1,000. And we know that our coupon rate in the question is 8%. So then you're going to do 1,000 times 8%, so you can get 80. Divided by the number of payments, which is 4, you're going to get 20. So you get 20 here. So we then have our C. And what about our yield to maturity? What about our KB? Well, yield to maturity is going to be easy as well. You're going to take your YTM, okay, and you're going to divide it by frequency, so your number of payments. In this case, you're going to have 4 divided by 4, well, 4% divided by 4, and you're going to get 1%. Okay. So in this case, we have our KB. And that's what we're going to plug in over here. So we're going to plug in over here. So we're going to plug in over here. Now, last but not least, is finding our number of periods. Our number of periods will be very straightforward. Our number of periods is simply number of years times the number of payments per year. And that will be 10 years times 4 payments per year, such that we get 40 as our N. So now we have our N as well. So we have all of the things that we need to solve for the present value of this bond. Look how everything here is exactly what we just identified. Okay, so we got 1,000, we got 20, we got 1%, and we got 40. It's amazing news. So we can go ahead and just zoom out, zoom in. There you go. So to make this simple and to make this fun and interactive, we're going to go ahead and kind of do two things. We're going to break down this formula into two portions. We're going to have portion A, and we're going to have portion B. We're going to solve for A and B, and we're going to add them together, and that's going to be the price of our bond. That's usually how I used to break down these bond valuation formulas for my students within the bond valuation chapter. So let's go ahead and do that. Let's try to solve for A first. And A, essentially, will be, we're going to take our coupon, divided by 0.01, multiplied, by 1 minus 1 over 1.01 to the power of 40. If we go ahead and plug that in within our formula, we should get something cute. I hope we do. It's always a game of hope in life. We're going to get 20, whoops, over 0.01 multiplied by 1 minus 1 over 1.01 to the power of 40. Now color me purple if I don't get this correct. Should be good. Cool. So you're going to get the following value. You're going to get 656. Sorry, I'm plugging this in my a symbol lab just to make this easier for myself. You're going to get that 69372. And that's going to be for portion A. All right. Now we could do portion B. Portion B is mad easy. All that you're going to do is 1,000 over 1.01 to the power of 40. So in other words, you're just doing some simple discounting. And what you're going to do, if I just erase all these bad boys, you should be getting something, I don't know, like 200, 600, no. Yeah, that makes sense. Cool. So you're going to get 671.65313. 65313. Now what we're going to do here to find the price of the bond, we're just going to do A plus B. And that's going to give us, by the way, just to show you that I'm correct, we have these two amounts. And that's going to give us essentially here 1328.35. And that's going to be the price of our bond. Okay, so I guess I'll write this as being 0. Now, a quick piece of context for you. The reason why we have a bond that's trading at a higher price than our face value is because, well, the firm, in this case, I believe it's Shy Designs, it's paying a coupon rate that is higher than the market rate. And for that reason, people are more incentivized to get this get this bond, because they're going to get higher interest payments in comparison to other similar bonds in the market. A quick little reminder on what we did back in the days in our intro to financial accounting course. So now that we have that, we are happy because we now have the price of the bond. And we know that we have in this question a bunch of bonds outstanding. If I'm not mistaken, it should be 100,000 bonds outstanding. Yes, it is. So what you're going to do is you're going to do 100,000 multiplied by 1.328.35, and that's going to give you debt. Not debt like dying, but debt like I'm cringe, but debt like the debt value. So we got a price of our bond. We're super stoked. We got 100,000 bonds. We know that it's the price, such that if you multiply these two numbers together, you're going to get the value of debt. And in this case, it's a poquito big amount. And we could say that we got 132.83466. Well, I'm so sorry. 0.11. And that's going to be our value for debt. Okay. And just like that, this is starting to get kind of fun, kind of easy, because we walk through these steps and we have all the tools already. I mean, we've done this the whole entire chapter. And I always like to do like a sense check as I'm going through this, but this definitely, we are in the right path and we have the right answers. So now we can move on into the last portion of the question, which is our preferred shares. So the first part for us, what I'd really like to work with, is kind of figuring out, well, what is the price, okay? What is the price of one individual preferred share? And in these types of questions that I gave you here is, well, what you're going to do is you're going to take the par value multiplied by the premium and or discount provided in the question. So if you recall, we know that we had, if I could go back really quickly to find, we had essentially $0.5 million in turn million. I'm so sorry, 0.5 million shares outstanding. Not bad. I'm getting a little bit tired. We're 54 minutes in. I'm getting a little bit weird. And we know that the face value is 100. Okay. Now this is going to help us to find the value for preferred shares, but what we really care about is the face value, and we know it's trading at a multiple of 92%, such that in order for you to find the present value of the bond, of preferred shares, all that you're going to do is 100 times 92%. And this means that one individual preferred share is selling at 92 bucks. It's really as easy as that, okay? So we could go ahead and highlight this number right here, 92 bucks per preferred share. It's kind of a walk in the park. Now that you have that, we could go ahead and find, if you want, we'll skip a step and we'll go straight into finding the value of our preferred shares. Because we know we have 500,000 preferred shares outstanding, and we know that they're trading at $92 each, we could go ahead and find the value for preferred shares. And in this case, the value for preferred shares is equal to 92 times 500,000. If I let me try to show my quick math skills, which I probably don't have. I'm going to say it's between 4.5 million. I'm going to say 4.6 million. 46 million. Damn, pretty bad. I don't know how to do my zeros. So we're going to have $46 million here. All right. Very easy math. I feel like anybody can have done that. I don't know what I'm trying to flex here. And then we're able to get our value of preferred shares of 46 million. Now it's a question of finding our required return on preferred shares, or the cost of issuing preferred shares. Well, we need to find DPS, and DPS is pretty straightforward because all that you got to do is you're going to take your par value multiplied by your preferred rate. That's going to give you $100 times, in this question, I believe it was 5%, such that your DPS is equal to $5. Look how easy that was. Then you're going to do $5 divided by $92. So you're going to get, I guess I'm going to try to find some space. Whatever, we'll be doing this. KP will be equal to $5 divided by 92. And that means that your KP, if we do some math together, equal to 5 divided by 92. That's going to give you 5.435. Am I on? Okay. Okay, my calculator, it likes to round up stuff. I was so scared. I was like, am I crazy? Am I not doing very well right now? So you're going to get a KP of 5.43478%. Now, if you could hear the music that I have playing in the background, I'm starting to get a little bit concerned because I don't know what's playing. It's getting weird. So with that, we could go ahead and kind of identify all the good stuff that we have. So now that we have our value for debt, our cost of debt, our value for preferred shares, and our cost of preferred shares, go back into our WACC formula at the top. And we could get that little instant gratitude, that little dopamine fix, because we could say that we have our cost of debt. We could say that we have D. We could say that we have KP. And we could say that we have P. So now we're pushing P, and we're able to find the value of the firm. The value of the firm, to make it super clear to y'all, it's going to be simply equal to E plus D plus P. So let's go ahead and highlight what is the value of the firm right now. So I guess I'm gonna write it right here. And we'll zoom in a little bit for now. So now that we have all these values, we know that the value of the firm, if you add all the numbers that we had prior, is going to be equal to 191,939,226. That's going to be the value of the firm. And if you want some active recall, we did 46 mil plus 132 mil plus 13 mil. Okay, that's exactly what we did. If we zoom out a little bit, 46 million, 132 million, and where is it? It's at the top, 13 million. And that's going to give us our value of the firm. And with that, let's take some time to just highlight what our EV is. Okay, let's take some time to do just that. Whoops. Underscore. Oh, okay. So let's try to do that real quick, just to identify these pieces because they're important to us. So our EV, okay, which we'll highlight here in yellow. We could go ahead and call that being essentially 13 million over 191 million. If you do the math, okay, because I'm a little bit lazy now, you have the numbers, we did this together. You're going to get EV as being equal to 6.83%. Okay. If we go to do our debt over value, you're going to get 132 million of 834,686 approximately over 191,939,226. And that's going to give you essentially, if I were to maybe just put this here, you're going to get 69.21%. And finally, what you could do to find the preferred values, you could add 69.21 plus 6.83 and just find the remaining piece. Or you could just do the math, which would be 46 million over 191,939,226. And that's going to give you a preferred value over value of the firm of 23.97%. Now, note that I did round these answers a little bit, just to make this easy and quick and digestible. But I think you get it at this point. So we go ahead and highlight these in the colors that we've been using from the very beginning. So now that we have all this, let's go ahead and plug this in within our formula, and we're going to work through this step by step together, because why not, right? So look at that. We have everything that we need in front of us now. So just to make this an exercise that you could actually internalize and do with me as we go, I'm gonna drink some water before though, just because I've been talking for an hour now. So we could go ahead and do this. We're gonna go and identify colors. Why not? So our cost of equity, I'm gonna put it as 15.51%. We know that our equity to value is equal to 6.83%. We know that our cost of debt is going to be equal to 4.06%. For sure, I'm rounding it up, by the way. And our debt to value, or I guess our tax rate in this case, it's 28%. We need it for this. Our debt over value is going to be equal to 69.21%. So we have all of that good stuff. Then we could go and move on to our cost of preferred shares. We know that that's equal to 5.43%. By the way, I'm rounding it up, so please don't, kill me if I do this like this. And then our preferred value over the value of the firm is going to be equal to 23.97%. Okay. So what we're going to do is we're going to work as a team right now, and we're going to solve every single one of these one by one, and then we're going to add them up together, and we're going to find a WACC. Okay. I know that this was long. We're at 45 minutes almost. But on an exam, once you've identified these steps, or if they want you to do just one portion of these steps and then solve for WACC, you're going to be equipped. You're going to know what to do. So let's go ahead and do that. So for the first portion, cost of equity times the equity value over the value of the firm, you're going to get something really interesting. You're going to get a very small amount. And the reason why you're going to get a small amount is because the prorated cost of equity is going to be much smaller, since only 6% of the firm is being raised through equity. You're going to get a number that I'm going to round up as being the following. All right. Now let's go on and solve for the cost of debt. Cost of debt is going to be a walk in the park. All that you're going to do, you have 4.06, 1 minus 0.28 over 6 times 69.21. You're going to get a cool amount. You're going to get 2, and I don't need to round this one up too much there. 2.023146. Okay, so that's going to be for your cost of debt. Now we can go ahead and look at our costs for preferred shares, our prorated cost for preferred shares, if I were to be more strenuous. And we're going to have the following, 5.43%. Now, by the way, I already have all these answers. I just want to make this interactive. I've been saying that probably twice now. But it makes it more fun. You get to work with me. You get to have some context. You get to see how I solve this without just plugging this in within my calculator there. And for the preferred for the prorated version for your preferred shares, you're going to have 1.301571%. So if we add all of these together, we're going to get WACC. Okay, let's go ahead and do that. Let's go ahead and add all of these bad boys together. So we have 1.0593 plus 2.02314,672 plus 1.301571. We're going to get the following value. And it's pretty darn close to what I have in my solution. So I'm pretty happy with that. So we're going to get a WACC of being equal to 4.3840172%. And that's going to be the weighted average cost of capital of the firm. And hooray, you're happy because we got our answer. And it's actually very close to what I had. Because on my solutions with no rounding up, I got 4.3843. That's very, very good. On an exam, you'd be on the ball. So let's take a step back though, because we did a lot of stuff here. I mean, we're 47 minutes in within this portion of the video, and congrats if you're still here. But what's awesome here is that we just had to identify the pieces of the question that we need, because with our flowchart, we knew exactly what to do. We knew what information we had to highlight. We knew how to find our market value of equity, debt, and preferred shares, and then we knew how to find the cost of equity, debt, and preferred shares. Of course, you are required to find the price per share at times, and that's just the name of the game. But I think you're really on the right track at this point. So let's go ahead, and I know you're tired if you're still on this video, but let's go ahead and run, like literally sprint through another version of this question together. We're just going to go ahead and highlight